I'm not going to drop them unless they give us something that's, substantial. Otherwise, I'm not going to drop them.
The United States is planning to impose new port fees on Chinese ships. They'll be applied to all Chinese ships docking in the U.S. ports.
U.S. imports from China last year hit nearly $440 billion.
Suddenly empty container ships, slowing port activity and falling freight rates. From soaring energy prices to a contraction in the logistics sector, we hear a new shocking news in global trade almost every day. But do you know why cargo ships from China to the US have recently been returning almost empty? This anomaly, which has been observed for months on the cargo route from China to the US, has been at the center of the global trade agenda. Data shared in the American media show that containers leaving China are not as full as they used to be. Chinese media claim that this is a short-term fluctuation. But industry experts say that many indicators, from export figures to port registrations, point to a major change. Are tariff wars really closing China's biggest revenue stream? Is this country, the world's largest producer, facing a loss of billions of dollars before it can fill millions of containers? Let's take a look at the background of this sharp decline from China to the US. There is an atmosphere in which ships that cannot fill even half of their containers are experiencing voyage cancellations, major logistics operators are issuing profit warnings, and freight rates have almost bottomed out compared to previous years. This picture reflects a serious contraction in the US market, which is referred to as China's biggest source of income. Some estimates suggest that this contraction could cost China billions of dollars in lost exports by the end of 2025. While images of empty ships are circulating on social media posts, American sources report that cargo occupancy rate fell below 60% in the last quarter.
See these cans? They not that tall. These things are usually stacked up like buildings. And this side is completely empty, look.
The decline in this rate, which was once above 90%, indicates a significant shakeup in logistics chains. Tariffs, threats of sanctions, and tariff policies, especially since President Trump's first term, seem to have weakened the position of Chinese products on US shelves. As demand in high-volume categories, such as electronics, textiles, and toys, has started to decline, China, seen as the factory of the world, is struggling to find orders to fill its containers despite its huge production capacity. One of the short-term dimensions of this problem is the sharp drop in freight rates. Container freight rates, which were thousands of dollars 2 or 3 years ago, have fallen to the $2,000 to $2,500 range today. For ship owners, line operators, and port operators, this development means a rapid erosion of profits. Moreover, the sector, which is used to operating in terminals built with high capacity, is facing a huge loss of revenue due to voyage cancellations and reduced schedules. Social media and various sources emphasize the risk of China losing up to $100 to $300 billion a year in exports in the process. Experts remind the importance of the US market for China and state that such a deficit cannot be easily compensated in other geographies. Europe's own economic problems and the relatively limited market volume of Africa and the Middle East may be insufficient to close this gap. This, in turn, will have a negative impact on China's gross domestic product and, combined with the recent real estate crisis and rising unemployment, could create greater social and economic pressure. If this picture is correct, a huge loss of revenue for China could be inevitable. How much damage does the cargo halt really imply for this factory of the world? How are tariff policies, political tensions, and shifts in consumer demand triggering this crisis? And most importantly, is this rupture permanent or just temporary turbulence? For many observers, the slowdown of the cargo route from China to the US has become one of the biggest economic stories of 2025. Citing customs data published in the American media, experts say that the occupancy rate of export containers fell dramatically in the last quarter. In this line, which was once said to have never fallen below 90%, occupancy rates today are said to be in the 50%, 60% range. This means the following: the ships that set sail leave empty or half full. Consequently, container freight rates, once hovering around $7,000, $8,000, have now fallen to $2,000, $2,500. The maritime transportation industry is being squeezed between overcapacity and low demand, the American media wrote, while the industry's giant ship owners started to announce sharp declines in their profit reports. So, why is this picture especially true for cargo flows from China to the US? Economists attribute this to several main reasons. First, the trade wars that have escalated in recent years. The US tariffs and threats of sanctions against China have pushed American companies to seek alternative supplies. Some producers have turned to countries such as Vietnam, Malaysia, and India, while others have shifted production to Mexico or their home countries. As a result, the outsource production in China and ship it to the US model began to lose power. Secondly, high inflation and the change in spending patterns in the US economy following the pandemic are slowing down consumer demand. There is a sharp decline in demand for Chinese goods, especially for middle and lower income groups. Retailers are pulling back from long-term contracts with China, saying, "Most of our warehouses are full of winter stocks right now. We are not going to risk new orders." This has created a vacuum rather than congestion at Chinese ports. The third factor is technology tensions. US export restrictions are weakening China's hand in semiconductors and advanced electronics. Instead of buying such components from China, American companies are turning to other suppliers. In other words, not only in textiles or plastics, but also in high-value added electronics, the Sino-US line is shrinking rapidly. Of course, the Chinese administration emphasizes that this downturn is short-lived and the contraction in the US market can be compensated in other regions. Some commentaries in the Chinese media suggest that African and Middle Eastern markets are growing and that new deals with Europe are on the way. However, experts agree that the US alone has an enormous consumer base and the size of other markets cannot be compared to the US. Therefore, China may not be able to make up for the billions of dollars lost by expanding into Africa or South Asia alone. According to some analyses, the cost of this contraction to the Chinese economy could be frightening. While in the recent past, China exported more than $600 billion a year to the US, this figure could potentially fall to $400 billion by the end of 2025. A difference of $200 billion could mean a loss directly reflected in China's gross domestic product, especially if some pessimistic scenarios suggest a contraction of more than $300 billion, a development that could upset the economic balance for China. But how decisive are the political factors behind all this? Former US President Trump was known for his harsh rhetoric. "We have closed China's biggest source of income. We are encouraging manufacturing in our own country." Many of the tariff policies he initiated have largely continued in the subsequent period. The strategy of drying up China's source of exports found broad support in American politics. After all, not only Republicans but also Democrats are in favor of protecting domestic producers. This consensus unites the US along the line of reducing dependence on China. Some comments circulating on social media share photos of empty ships or images of no cargo expected at ports. American port authorities put out official figures saying that port traffic is down 25 to 30% compared to last year. This is a decline beyond the usual slowdown. The messages from Chinese ports are the same. We can't find orders to fill containers. Some logistics companies are even allegedly cancelling additional voyages because they say there is not enough cargo to cover even the cost of the ships. Chinese media interpret this development as meaning that American consumers will be forced to buy more expensive domestic products. This is partly a correct analysis because moving away from China comes with a certain cost for American companies. However, the US is either absorbing this cost or trying to minimize the price difference by turning to countries such as Mexico through new trade agreements. The concepts of nearshoring and regional supply chains have become a hot topic, especially in the North American economy. China can overcome this shock if it rapidly increases its domestic consumption, economists say. But domestic consumption growth alone may not be enough to absorb the huge export capacity of the manufacturing sector. With youth unemployment already exceeding 20%, data suggests that China's slowdown risks turning into a social crisis. The collapse of the real estate market, the high cost of living in the big cities, the low purchasing power in rural areas are all factors limiting the growth of the domestic market. At this point, the term multi-billion-dollar hit does not seem exaggerated. Some estimates suggest that a shipping slump from 2024 to 2026 would cost China at least $150 billion in lost revenue, and in a worst-case scenario could be as high as $300 billion. That's a lot for even the largest factory in the global economy to absorb. It would be a loss that could reduce Chinese GDP to less than 5%. In the American media, this is interpreted as a signal that the economic divergence with China will become permanent. From consumer goods to technology products, the race to find new suppliers to replace China could accelerate. Even the share of Chinese products on the shelves of large retail chains is gradually decreasing. In categories ranging from shoes to electronic accessories, made in Vietnam labels are on the rise. India is expanding its electronics assembly plants, while Malaysia and Indonesia are also in demand for textiles and component production. But China is not disappearing completely. It still has the world's most advanced supply network, huge production capacity, and logistics infrastructure. Yet tensions with the US are likely to erode this strength in the long term. Many users on social media have commented, "Until now we were buying everything from China, and now we are slowly moving to buying everything elsewhere." This is of course not happening at the same pace in all industries. But it is clear that there has been a major shift in areas such as food, textiles, low-cost consumer goods, and mid-segment electronics. While Chinese companies keep investing in logistics, from the shipping industry to container production, it is surprising that orders to fill this capacity are not coming in. Before, you had to wait in line to find containers. Now it is very cheap to rent containers, it is said. This difference could create the potential for a $200 billion shrinkage in the freight market in an instant. Many of the world's largest container line operators have revised their earnings forecasts significantly. So it's not just China, the global shipping industry is being hit hard. The picture is empty ships and the routes are paralyzed. Of course, the word paralyzed is an exaggeration, but there has certainly been a dramatic decrease compared to the overcrowding experienced in previous years. If we remember a time when ships were waiting for weeks to dock, today we are seeing a reverse crisis. There are no ships waiting, even cancelled sailings. Such a sudden drop in demand points to a global recession, some business circles say. Chinese media argue that the US is creating unfair competition with tariffs and technology restrictions, which will slow the global economic recovery. The US consumer will end up buying more expensive products. This is shooting itself in the foot, some commentators say. Of course, the American side is loyal to the protecting our own producers narrative, and this narrative has support among the public. From a political point of view, neither the Democrats nor the Republicans are likely to go back on this line. Thus, instead of loosening trade between the two superpowers, divergence is accelerating. Who will pay the bill for this divergence? Some economists say, actually, both sides lose, because the prosperity arising from global trade diminishes. Others argue that the US will gain in strategic independence, while China will have to transform its growth model. Time will tell which thesis is correct. Analyses shared on social media platforms suggest that by 2026, the trade volume between China and the US could shrink by 20 to 30%, while the US will continue to turn to other countries in Asia. Tech giants are also looking to spread their risk by shifting production to alternative locations. If this trend continues, China may still be a major manufacturing hub, but it will start to lose its status as a lone giant. Of course, the pandemic also has an impact on this development. In the post-pandemic period, logistics chains were already uncertain, demand was volatile, and inflation was rising. Now, tariffs and geopolitical tensions, together with the pandemic, have created the perfect storm. This is precisely where the development gained momentum, and it seems that there is no sign of turning back in the short term. While the American media said, we are seeing a very clear decline in demand for agricultural products, textiles, toys, and electronic accessories, the Chinese narrative is that the US economic situation is already fragile, and if it goes into recession soon, it will cut its own consumption, and the whole world will suffer, not just China. In other words, both countries are defending their thesis, but the figures clearly confirm the stagnation of shipping traffic towards China. Economists do not give a clear answer to the question, where does this lead? Some expect some kind of normalization between 2025 and 2027, while others predict that US-China tensions will escalate from the technological to the security dimension and the trade divergence will deepen. If the latter scenario materializes, China's multi-billion-dollar blow will be permanent, and the axis of world trade flows will shift. In fact, this would mean not only a change in shipping lanes, but also a transformation of the very phenomenon of globalization. Global trade, which has grown since the 1980s under the ideal of a one-world market, will perhaps evolve into a more regionalized structure. This may open up new opportunities in terms of logistics. For example, Mexico, Latin America, Eastern Europe, and Southeast Asia could attract investment flows. However, If China, with its huge capacity, steps back, production costs will rise and end consumer prices will rise. As a result, even though the narrative that shipments have stopped in China, cargo routes have been paralyzed, China has suffered a multi-billion-dollar blow, may seem like an exaggeration, it has a high share of truth. At the very least, there has been such a short-term atmosphere that ship capacity, freight rates, and export revenues have been severely reduced. While American policymakers continue to impose tariffs and restrictions, China is trying to salvage the situation with new markets or domestic consumption. However, if this effort does not yield results today and tomorrow, the structural problems in the Chinese economy may multiply. It is uncertain which way the wheels will turn now. But one thing is certain. The world has become a trade arena where the two superpowers are pitted against each other. From ship routes to freight prices, from port statistics to inventory management, every indicator bears the traces of this battle. And we will continue to watch this scene unfold in the coming months or years. So, who do you think will gain or lose more from this development? Is China entering a deep crisis in its export-led growth model, or can it overcome this problem by adapting to new markets? Is the United States winning an unquantifiable victory, or are its gains limited by domestic dynamics such as inflation and production costs? Perhaps a clear answer to these questions will emerge over time. For now, what we can see is that Chinese exports, which have been growing like a bullet train, are breaking, container ships are returning empty, and the logistics industry is ringing alarm bells. Such a big change does not happen every period. Therefore, the consequences could be so big that they will be talked about even in the 2030s. Thanks in advance, and don't forget to join this discussion in the comments. Subscribe to our channel and turn on notifications to keep up to date with trade, energy, and geopolitical developments around the world. See you in the next broadcast.